When you have been trading for as long as I have, you often forget what it's like to think like your old self when you just started out. As a beginner, you might have made many impulsive thoughts. For example, you might make a decision based on one thing you see. Your thought process can easily become very biased in a market when you're new. However, once you gain some experience and inevitably incur some losses, you realize that just one condition being met, such as being near resistance, is not enough to take a trade. Sometimes it will work in your favor, but often relying on just one indicator will lead to overall losses and frustration. I began to set different conditions that needed to be met, not just one indicator, but typically three or four. Principle number one, weight of evidence. Weight of evidence investing is an investment strategy that involves analyzing and combining multiple indicators and data points to make informed trading decisions. Instead of relying on a single indicator or a signal, this approach takes into account a variety of factors such as technical analysis, market trends, economic data, and sentiment analysis. By aggregating these diverse sources of information, investors can develop a more comprehensive and nuanced understanding of the market, which helps in making more accurate and reliable investment decisions. This method aims to reduce the risk of impulsive or biased decisions by ensuring that investment choices are based on well-rounded and thorough analysis. So let's go over the weight of evidence that we are in a bull market. The first weight of evidence I want to give you is that the presidential election cycle theory. What this says is that the fourth year is usually a positive year in the market. The third year is usually better than the fourth year, which exactly followed the scenario. Another weight of evidence that tells us that we are in a bull market is the stage analysis. How many stocks are trading above the moving averages? We specifically look at the NASDAQ, and it is clearly still in an uptrend. Now, thus saying that, the Magnificent Seven is what's holding up this market, what we call the tale of two tapes. The indicators are not as important as understanding that what we are doing is building a case of why for the next 6 months, this market is in a bullish uptrend. Thus saying that, we've been telling you for the last year and 7 months that we've been in a bull market and to buy on pullbacks, specifically in the Magnificent Seven. But this video is just to explain you how we build a weight of evidence. I have over 100 indicators just for the macro. And then the weight of evidence continues further for the sectors and the individual securities. However, there's one point in my trading career where things really shifted. It had to do a lot with the way I was thinking and perceiving the market and traders on both sides. Bull traders and bear traders, people going long and people going short. When I started to take a broader perspective, considering the bigger picture, my approach changed. Yes, we might encounter some resistance, but overall, where is the bigger trend and where do I think it's going? Principle two, the macro to the micro. Forest to the trees approach is a method of investing, analyzing that begins with a broad examination of the overall market and then systematically narrows down to focus on specific sectors and finally individual securities. Overall market, macro to the forest. Start by analyzing large-scale economic indicators, global market trends, central bank policies, and geopolitical events. Purpose, understanding the general market environment, economic health, and overall market sentiment. Then I go to the sectors. Analysis. Once the macroeconomic outlook is established, narrow the focus to specific sectors or industries that are poised to perform well or show resilience given the broader market conditions. Purpose. Identify which sectors are likely to benefit from the current economic trends and conditions. Individual securities. Micro. The trees. Analysis. Finally, within the chosen sectors, conduct a detailed analysis of individual securities, stocks, bonds, etc. This includes examining financial statements, company performance, competitive positioning, management effectiveness, and other factors. The purpose, select the individual securities that are best positioned to perform well within their sector based on both macroeconomic backdrop and sector-specific dynamics. By following this structured approach, investors ensure that their decisions are well informed by the broader economic context while also capitalizing on specific opportunities within sector and individual securities. This method enhances the overall strategy, aligning macroeconomic understanding with micro-level investment choices. It's a simple approach of thinking that if you concentrate most of your effort on which direction the overall market is going, there are better chances that you will be right. Then to find the specific sectors that are doing very well, and then to break it down in those specific sectors, the individual securities. This has been a big part of my investment philosophy. I call the forest to the trees, the macro to the micro, a three-part process. What is this three-part process looking right now? If you're looking at the overall market, the weight of evidence is we are still bullish. If you're looking at the hottest sector out there, that's semiconductors, artificial intelligence, throw in Magnificent Seven, and if you look at the individual securities, NVIDIA has led the way for the last 2 years. And we believe nothing has changed. Artificial intelligence will lead the way. There will be pullbacks, but for the next 6 months, buying the right individual securities will lock in the profits on the bullish side. Principle 3, if and then statements in investments. In investments, if and then statements are a structural approach to decision making where specific actions, B or C, are predetermined based on occurrence or non-occurrence of certain conditions or events A. This method helps investors create a disciplined and systematic strategy for reacting to market changes and other investment scenarios. If a certain condition in the market happens, then I will do this. If these three things happen in the market, then I will do this. Further explanation. Identify key conditions. A, determine the primary condition or events that will influence your investment decision. These could be market movements, economic indicators, sector performance, or specific stock prices. Define actions B and C, specifically the actions you will take if those conditions occur. B, or do not occur. C, these actions might include buying or selling securities, reallocating assets, or adjusting your investment strategy. A simplistic example. Overall market movement. If A, the overall market rises by 5% happens, then B, increase investment in growth sectors. If A doesn't happen, then C, hold current position and reaccess market conditions. Sector performance. If A, the technology sector outperforms the market happens, then B, allocate more funds to tech stock. If A doesn't happen, then C, diversify into other sectors showing strength. Stock price target. If A specific stock reaches a target price happens, then B, take profits on some shares. If A doesn't happen, then C, continue holding and monitor for further signals. Application. By using if and then statement, investors can create a flexible yet structured framework that allows them to respond systematically to various market conditions, ensure preparedness for different scenarios, make informed decisions based on define criteria, maintain a discipline, and reduce emotional decision making. This method helps investors to align their actions with their overall investment strategy, providing a clarity and consistency in their approach to managing their portfolios. Just a quick real life example of if and then statements. If the VIX hits the recent high with the right X ratio in a buy area, stage analysis for the QQQs in bullish vicinity, then we buy the QQQs. Simple but effective strategy for if and then. In conclusion, developing a strategy, a consistent and disciplined plan is essential to achieving your trading or investing goals. It requires thinking differently and maintaining discipline. My motivation for creating these videos is not to sell or promote anything, but rather to enhance my understanding of the profession. By articulating these concepts in the video, I aim to improve as a trader. For those who have been following us for years, you're aware of our track record of successful recommendations. Remember the catchphrase, study it, analyze it, adapt it. Peace.